Have you ever looked at the stock market during a major global crisis and just wondered, are we even living in the same reality?
Oh, absolutely. It's surreal.
Right. You turn on the news, and it is just wall-to-wall coverage of geopolitical escalation. Military strikes, regional instability, absolute chaos unfolding in real time.
Yeah.
And then you open your investment app, and the stock market is just humming along.
Barely a blip.
Exactly. The indices are maybe even flashing green.
Yeah.
They seem completely unbothered by the state of the world. So if you've been feeling that profound cognitive dissonance recently, you're absolutely not alone, and you're exactly in the right place today.
It is an incredibly unsettling dynamic to watch play out. Asset prices are living in one universe, while physical, boots-on-the-ground reality is living in another. Today, we're going to bridge that gap and look at exactly why that massive disconnect is happening.
Yeah, we're diving into a really fascinating piece of source material today. It's a highly detailed Q1 2026 strategic financial analysis document.
It's a heavy one.
It really is. It was put together for institutional clients, and it focuses heavily on the geopolitical risks erupting in the Middle East right now, specifically concerning Iran.
Right.
But more importantly, it breaks down how the global financial markets are wildly, almost dangerously, mispricing these events. So the mission for our deep dive today is to decode why the market seems so artificially calm right now.
We need to pull back the curtain.
Exactly. We're going to uncover the hidden systemic cracks beneath this shiny surface and figure out what this actually means for your understanding of global economics.
And my focus today isn't just to recap the daily ticker tape, We need to explore the underlying mechanics. Why are the financial markets currently exhibiting this massive decoupling from fundamental reality?
Because it's not normal.
Not at all. Historically, when asset prices separate this drastically from the physical risks on the ground, that is precisely when systemic vulnerability is at its absolute highest. We are looking at a very precarious setup.
Okay, let's unpack this. Because the source throws out a data point right at the beginning that perfectly captures this dissonance. The S&P 500, arguably the most important stock index in the world, reacted to a massive escalation in global conflict by opening lows.
Which makes total sense.
Right. But then it almost immediately shook it off. It reversed course and actually recovered by about 0.8% on the day.
Unbelievable.
It created this illusion of a perfectly calm, bulletproof market. How is that even mathematically possible, given the level of global instability?
What's fascinating here is how the analysts categorize this specific market behavior. They don't call it resilience. They actually call it a false calm.
A false calm.
Yeah. Investors are currently applying a psychological framework that the document refers to as the Venezuela Fallacy.
But wait, let me challenge that for a second. Is it really a fallacy? I mean, we're in an election year in the U.S. The administration is highly motivated to keep the market stable and gas prices low. So isn't it logical for investors to assume the powers that be will just force a quick surgical resolution?
That is exactly the trap of the Venezuela fallacy.
Oh, really?
Yeah. The market is copy-pasting a historical scenario, a localized geopolitical event with a highly controllable, rapid conclusion onto a completely different present reality.
Ah, I see.
In the Venezuela scenario, you have a brief flare-up. It resolves before it meaningfully disrupts global supply chains. Investors are using muscle memory to assume this current Middle East conflict will be over by the weekend.
But the strategic analysis firmly points out that this optimism is a complete facade. I mean, the facts on the ground are moving in the exact opposite direction of a quick de-escalation.
Totally the opposite.
The reality check laid out in these pages is incredibly stark. We aren't just talking about heated rhetoric or a localized skirmish here. High-ranking officials have been killed.
Yes.
And in direct response, Iran has attacked U.S. and allied bases spread across Bahrain, Qatar, the UAE, and Kuwait.
Which is a massive regional footprint.
It's practically the entire Gulf.
Precisely. And then you have to look at the timeline provided in the assessment. The document highlights a strategic projection from President Trump, estimating that this conflict will require a time frame of at least 4 weeks, if not significantly longer, just to achieve its objectives.
4 weeks minimum. That completely shatters that whole over-by-the-weekend narrative the stock market is trading on.
It absolutely shatters it. It tells us that the market is completely mispricing both the depth and the duration of this event. When you have coordinated strikes across multiple sovereign nations in the Middle East and a projected timeline stretching out for over a month, the idea of an immediate, tidy resolution is just unfounded. Investors are playing with fire.
Right, and if this drags on for a month or more, There's no way it stays contained to just military bases, right?
Yeah.
Does the assessment dig into the spillover risk to the actual global oil supply? Because that seems like the elephant in the room.
It is the defining variable. The document zeroes in on the Strait of Hormuz. And it doesn't just label it a military target, it defines the strait as a binary risk to the entire global economy.
A binary risk, like an on-off switch.
Exactly. It's essentially an on-off switch for global growth. We
Yeah.
are talking about 20 million barrels of oil flowing through that narrow waterway every single day. That represents a full 20% of total global oil output.
Wow.
If that switch gets flipped off, the cascading economic effects are almost incalculable.
That is a staggering bottleneck.
Yeah.
But reading through the breakdown of energy flows, there's a weird nuance happening right now. A massive amount of Iran's oil is actually still flowing, and it appears to be flowing primarily to China. Why is that supply chain still intact in the middle of a war zone?
It's a vital piece of the puzzle. Right now, U.S. and Israeli forces are operating with strict targeting priorities. They are exclusively going after offensive capabilities, missile launch sites, radar installations, military command centers.
Keeping away from the oil.
Right. They are intentionally avoiding the energy infrastructure for the time being to prevent an immediate global energy panic. So the oil keeps moving to its primary buyers, like China.
But looking at the timeline laid out here, that seems like an incredibly fragile setup.
Extremely fragile, because if the conflict drags out as that 4-week timeline clearly suggests the target list will inevitably expand.
Right, they'll run out of the primary targets.
Exactly. Once the primary military targets are exhausted, or if the retaliation cycle escalates, the crosshairs will shift down the energy value chain. Refineries, export terminals, pipelines.
And then when?
The moment that physical energy infrastructure is hit, that 20% of global output is severely compromised, and a global supply shock becomes unavoidable.
Here's where it gets really interesting, because the analysis introduces a brilliant concept that completely shifts how we need to look at this choke point. We always picture the Strait of Hormuz being closed by a physical military blockade. Navy destroyers lining up, physically stopping supertankers.
On walls of ships.
Yeah, but the data suggests the real risk, the mechanism that could shut down the strait overnight, isn't military at all. It is entirely financial. Can you break down the analogy they use for this?
It's one of the sharpest insights in the entire document. They ask the reader to imagine driving a multi-million-dollar Lamborghini on a racetrack.
Okay.
But this particular racetrack is actively swarming with explosive drones and incoming missile fire. What financial institution, in their right mind, would underwrite an insurance policy for that Lamborghini?
I mean, come on, zero. Absolutely zero.
Exactly. And that is exactly what modern oil tankers are. They are multi-million-dollar floating assets, often carrying hundreds of millions of dollars in highly combustible cargo.
Which perfectly illustrates the concept of force majeure in international maritime shipping.
Yes.
Force majeure is a standard clause in these massive insurance contracts that essentially frees both parties from liability due to extraordinary, unavoidable events, like an active war zone.
So it's a financial kill switch.
Precisely. When marine insurance companies in London or New York look at the risk models and decide to invoke force majeure and pull their coverage, commercial shipping halts instantly.
It doesn't even matter if there isn't a single naval blockade ship in the water.
Right. Global transport conglomerates simply will not sail unprotected, uninsured assets into a combat zone. This financial mechanism, the withdrawal of maritime insurance, could effectively close the Strait of Hormuz far faster and far more thoroughly than any military navy ever could.
It's a system crash, not just a physical roadblock. Which brings us to the domestic impact. If that maritime insurance is pulled and that oil flow stops or even slows down, we are looking at a massive, immediate energy shock.
Okay.
What does this strategic assessment say about the fallout for the U.S. economy?
It brings us face to face with the Federal Reserve's absolute worst-case scenario, stagflation.
The dreaded S word.
Yeah. This is the toxic macroeconomic combination of stagnant economic growth paired with high, persistent inflation. The energy shock acts as a massive inflationary pressure. Suddenly, everything costs more to manufacture, transport, and sell because the baseline cost of oil is skyrocketing.
And at the exact same time, the geopolitical uncertainty and the high operational costs freeze corporate expansion and economic growth. You get the worst of both worlds.
But wait, the entire stock market rally we've been seeing has been built on the expectation that the Federal Reserve is going to cut interest rates. The famous Fed pivot to cheaper borrowing costs. If we hit stagflation, what happens to that pivot?
According to the hard data in this analysis, that hope is completely dead. The report cites current figures from the CME FedWatch tool, which is what institutional investors use to track the probabilities of Federal Reserve rate movements based on futures trading.
And what are they saying?
Right now, there is a staggering 97.4% probability that the Fed will hold rates completely steady at their upcoming March 18th meeting. The expectation of oil-driven inflation has entirely tied the central bank's hands.
Because if they cut rates to stimulate the stagnant economy, they just pour more gasoline on the inflation fire.
Exactly. They are trapped. They cannot lower borrowing costs when global energy markets are threatening to send the consumer price index through the roof again.
Now, the document also delves into the political calculus of all this. And I want to be very clear to you listening. We are looking at this strictly through the cold, calculated lens of the financial analysis provided in the source material.
Yeah.
We aren't taking sides. We're just reporting on the behavioral variables that these strategists are advising their institutional clients to model out.
Right. This is purely analytical.
Completely. The analysis suggests that as we approach midterm elections, there is a very real possibility that the current administration might use the Iran conflict as a sort of macroeconomic scapegoat.
It's a dynamic they refer to as the weaponization of inflation. The analysis posits that, from a purely domestic political strategy standpoint, pointing to an overseas uncontrollable conflict provides a highly convenient narrative.
Because it shifts the blame.
Yes. It allows politicians to explain away persistently high gas prices and sticky domestic inflation to the voters without taking the blame for domestic policy failures.
It moves the anger from Washington to the Middle East.
It does. And if we connect this to the bigger picture, the incredibly sobering takeaway from the institutional risk managers is this. Because of that dynamic, there might actually be a domestic political incentive to allow the conflict to prolong.
Yeah.
The political narrative of having a scapegoat might take precedence over the aggressive, stabilizing actions required for short-term economic relief. It is a harsh assessment of human incentives, but when you are managing billions of dollars, it's exactly the kind of variable you are forced to model.
So what does this all mean for the actual markets? If the stock market is showing a false calm and the political incentives are misaligned with economic stability, where should we be looking to see the truth? This leads us perfectly into the bond market, which, according to the data here, is acting very strangely right now.
The bond market is historically known as the adult in the room during a crisis. It operates on hard math, not sentiment. And right now, it is flashing bright red warning signs that the stock market is completely ignoring.
Because normally the mechanics are pretty straightforward. When a global crisis hits, investors panic. They pull their money out of risky stocks and they flood into U.S. treasuries, seeking a safe haven. Because there's so much demand to buy those bonds, the price goes up, and therefore the yield, the interest rate the government pays out on that bond goes down.
That's the textbook response.
Right. But looking at the charts in this document, we are seeing a terrifying paradox.
Yeah.
Currently, both the 10-year and 30-year U.S. Treasury bond yields are actually rising during a massive geopolitical crisis. Why is that happening?
That specific divergence is what the report calls the starting gun signal. Rising yields in the middle of a massive global conflict are a massive red flag. It indicates a profound structural loss of faith.
Lots of faith in what?
The system itself. The bond market is not blindly seeking the traditional safety of U.S. debt. Instead, investors are dumping bonds, demanding higher and higher yields to justify holding them. They are pricing in that long-term stagflation we just discussed. More importantly, they are signaling a total loss of faith in the Federal Reserve's ability to control this coming wave of inflation.
They're looking at the math and deciding the central bank can't fix the supply-side energy shock.
Exactly. The bond market is looking straight past the optimistic daily news cycle and seeing a fundamental long-term disruption. And this ties directly into the true underlying scale of the conflict outlined in the report, which is vastly larger than what equity investors are currently pricing in.
Wait, so if they aren't just targeting standard military sites, what is the actual scope of this operation? What is the assessment saying about the target list?
The scope is staggering. And it reveals that the strategic goal here does not appear to be simple, proportional retaliation. The data points toward full-scale regime change. The U.S. has actively targeted 3,000 separate locations across Iran.
3,000 locations. That is not a surgical strike.
It is not, and critically, the document notes that this target list includes domestic police stations.
Police stations.
Yes, this is a highly calculated move designed to actively support internal Iranian protesters. By intentionally degrading the state's internal security apparatus, the strategy is to allow a domestic uprising to gain traction and overwhelm the current leadership.
You are talking about the systematic dismantling of a nation's ruling structure from the inside out, aided by external military pressure. The level of volatility and uncertainty that a multi-week 3,000-target regime change operation injects into the global financial system is immense.
Huge.
And yet, if you look at the S&P 500 recovering 0.8% on the day, that volatility is absolutely nowhere to be found in current stock prices.
It's like watching a Category 5 hurricane approach on the radar while everyone on the beach is still setting up their umbrellas and buying ice cream. But the smart money, the institutional capital, is seeing the storm, and they are moving aggressively.
The report does mention that the U.S. dollar is seeing a short-term boost right now, a classic flight to safety, as global capital looks for liquidity. But it stresses that this is just a temporary illusion hiding a much larger structural tectonic shift, de-dollarization.
This is perhaps the most critical macro trend we are tracking. The Iran conflict and the massive financial sanctions that come with it are acting as an accelerant. It is dramatically speeding up the timeline for global de-dollarization.
Right, because other countries are watching.
Exactly. The BRICS bloc of nations, Brazil, Russia, India, China, South Africa, and their expanding membership are watching how the U.S. utilizes the dollar system as a weapon in this conflict. In response, they are moving much faster to build alternative financial infrastructure and settle global trade outside the U.S. dollar network.
And it's not just the usual suspects anymore.
No, the report even highlights that nations traditionally outside that sphere, specifically pointing to Poland, are accelerating their sovereign moves to diversify away from dollar dependence.
If nations are actively diversifying away from the U.S. dollar, where is all that sovereign capital going? The document points directly to gold. And it doesn't just predict a quick panic spike. It provides a really detailed forecast for a highly sustainable, structural bull market. How exactly does this timeline play out for the gold sector?
The analysts map it out very clearly, specifically looking at the mechanics of the gold mining sector. The timeline projects steady, highly stable growth through Q3 and Q4 of 2025. During this window, the fundamental profit margins for gold miners will dramatically expand.
Just to clarify for everyone, the spot price of gold is the current market price you can buy or sell physical gold for right now. So as that spot price climbs, what happens to the miners?
Well, a mining company's operational costs, the diesel for the trucks, the labor, the machinery, are largely fixed. So if their cost to pull an ounce of gold out of the ground stays the same, but the spot price of gold goes up by $200,
that entire $200 goes straight to their bottom line profit margin.
It's massive leverage. But that steady margin expansion is just the setup.
Then comes Q1 of 2026. The assessment forecasts an absolute breakout. It is driven by two massive macroeconomic forces colliding at the exact same time. First, you have immense waves of safe haven capital from retail and institutional investors fleeing the delayed stock market volatility.
And second,
that private capital slams right into massive, sustained gold hoarding by central banks around the world. Central banks are buying physical gold at record paces to backstop their own local currencies as they execute this de-dollarization strategy.
so if you are listening to this and wondering how on earth a professional investor is supposed to navigate a market that is entirely driven by chaotic news headlines, where these extreme tail risks are suddenly becoming everyday reality, the source document actually lays out a very clear battle plan.
Let's define that really quickly. When we say tail risks, we are talking about those highly unlikely catastrophic black swan events that sit on the very edge of the probability bell curve, right? The stuff that isn't supposed to happen.
Exactly. The 1-in-100-year events that seem to be happening every 6 months now. To survive this environment, the analysts provide 4 highly specific strategic recommendations to protect your portfolio. Number 1, beware the bull trap.
Megan.
They are explicitly warning against any FOMO, the fear of missing out. Do not buy into these technical bounces where the stock market briefly looks green and resilient. The report models that a deep, severe correction is highly likely in March, as the harsh realities of sticky inflation data and real-time recession indicators finally converge to shatter the market's illusion of calm.
So, rule 1, do not fall for the fake out. Protect your capital. What is rule number 2?
Number 2 is to optimize real assets. The recommendation is to maintain and actively increase your positions in physical commodities, specifically gold and silver. In a macroeconomic environment defined by stagflation, geopolitical chaos, and central bank hoarding, real, tangible assets are the ultimate and perhaps only defense against the rapid, systemic erosion of your currency's purchasing power.
Which makes perfect sense, especially given that massive Q1 2026 breakout forecast. What is Rule 3?
Rule 3 is all about execution, dollar cost averaging or DCA. The strategists strongly advise against going all in on any position right now. Even if you are aggressively buying gold, do not deploy all your capital at once.
Right, you need to deploy your cash in tranches, meaning you break your total investment into smaller chunks and buy in gradually over weeks or months.
Exactly. The extreme volatility we are seeing is not going to magically vanish. It's going to persist through March and likely far beyond. By deploying capital in tranches, you average out your entry price and protect yourself from sudden, violent intraday price swings. And finally, Rule 4. Monitor bond yields.
This goes right back to the paradox we discussed.
It does. The advice here is to completely ignore the noisy, easily manipulated stock indices like the S&P 500 or the NASDAQ. They are heavily distorted by short-term sentiment and algorithmic trading. If you want to know what is actually happening in the plumbing of the global financial system, watch the 10-year Treasury bond yield.
That's the real indicator.
That is your true north compass for asset allocation. If that yield keeps rising despite the crisis, the system is under intense structural stress, regardless of what the stock market is celebrating on any given day.
That is a phenomenal, actionable blueprint. Ignore the shiny objects in the equity markets. Watch the unvarnished math of the bond market. Protect yourself with real assets and pace your investments methodically. It really brings everything we've unpacked today into focus. The optimism you're seeing on your stock ticker right now. According to this comprehensive strategic analysis, it is nothing but a very thin shell painted over deep structural systemic cracks.
This raises an important question for you to consider as you digest all of this information. Where are you currently getting your signals? Are you allowing your financial worldview to be shaped by the shiny, artificially optimistic stock market headlines? Or are you looking deeper at the underlying realities of the bond market, the commodities sector, and the maritime insurance actuaries who deal strictly in hard math and physical risk?
It completely changes the lens through which you read the morning news. You start looking for the mechanics, not just the headlines.
It absolutely does. And I want to leave you with one final thought to mull over, building on the profound shifts detailed in this report. We discussed how marine insurance companies could effectively shut down 20% of the world's oil supply via force majeure.
Right, the financial kill switch.
Yes. So the question is, are we entering an era where financial underwriters, not politicians or militaries, hold the ultimate veto power over how and where global conflicts are fought? If they refuse to underwrite the risk, does the global economy simply refuse to participate in the war?
Wow. If the actuaries pull the plug, the ships stop sailing, no matter what the politicians say. That is an incredibly profound, paradigm-shifting way to look at the future of global power. Thank you so much for joining us on this deep dive today. We hope this helped decode some of the chaos, expose the mechanics beneath the false calm, and give you a much clearer lens to view the financial markets through. Stay curious, keep looking beneath the surface, and we will catch you on the next deep dive.